if the average age of the country is about 24, 25 for that matter, most of these startups are actually catering to people within our age bracket itself. Why do we have the capital class that's actually sitting one generation above that? Then obviously there's a dislocation. The dislocation that's there. So we have great diversification within that. And we said these skill sets are actually unique and can be best applied when it comes to this. And the core of finance and economics also for that matters to actually maximize gains from the most limited resources that are actually there.
Hello everyone, welcome to another episode of Finance Forward Season 1. Today we're going to talk about how do you start a fund from a venture capitalist. He's a chartered accountant, he's fairly young, I think we're almost the same age. This is his fourth fund. He started his first fund when he was about 23 years old. Today, fast forward, he's raised a round of close to 1,500 crores. 1,600 crores.
Actually, 500 million. 500, overall, the last one was about 200 million.
Yeah, so please welcome Mr. Siddharth Pai of 314 with me. Thank you so much for doing this.
Thank you.
So, I'll jump right into it about how did chartered accountancy happen? Because I read in one of the places that your brother, who's a few years older to you, said that I'm going to do my engineering. So that's going to handle the finance end of it.
Yeah.
But why did you choose chartered accountancy? You could have done any MBA.
No, so one thing. So my father's very prominent chartered accountant. My mother actually, I think, did everything except the final exam and chartered accountant.
Okay.
Did her law instead. So we always been a family of professionals that way.
Yeah.
Pranav was exceptional in the sense that he was your first engineer, the entire family as well. And since
weird for a South Indian.
Yeah. And from our side, from a family perspective, also we want to make sure there was the diversification within.
Yeah.
So that difference between him actually doing engineering, me doing CA, actually made complete sense also. And my interests also more or less aligned with that. So from a very young age as well, just the ability to actually manage the limited resources is something that my mother actually taught me very, very well. In fact, everyone believes my father was the one because he's a prominent CA, etc. Wound up actually teaching me that. But I learned a lot more about finance from my mother than I actually did from my father in that regard. Especially given the fact that my pocket money was about $100 a month. And that was all the way till college for that matter. So I just had to find supplemental source of income, make sure I started quizzing, did fairly well in that, managed to actually get through a large amount of college and extracurricular activities because of that. But there was always an interest in just sort of maximizing whatever you could from the smallest resource set available.
Yeah.
And the core of finance and economics also for that matters to actually maximize gains from the most limited resources that are actually there. So that's one of the reasons why it actually attracted me towards finance.
Yeah.
And one of the reasons, even while I was in school, I actually preferred law a lot more than actually preferred finance. In fact, I think that when I saw Boston Legal about the 9 to 10 standard, it was fantastic. One of those shows, you look at it and like everyone wants to be at Tenny Crane, wants to go there, win that entire case, win the span of 45 minutes to an hour, etc. But slowly, as I started speaking to more people, especially other lawyers, some people have actually done, some people actually cracked LAT, analysts, etc. What they said is, look, a lawyer, if you look at the entire deal concept that's actually there's usually one head lawyer head lawyers from both sides, so the associates sit at the back. But it's more or less a chartered accountant, someone who actually understands business, finance, economics, and law, who can end up actually taking a seat at that particular table.
Yeah.
So there was much broader scope that CA actually offered because CA is one of the toughest courses around, that way. And I think given the fact that the sheer volume you end up actually learning, because you need accounting which is translating every business action into something that can be presented in a financial statement. You have taxes, which I think is the core of the entire industry for that matter, both direct and indirect. You have corporate law that actually comes in a part of that. You understand finance, you understand how to actually start valuing these particular kind of assets and the like. I think there was actually a more grounded affair. So even though it was a much tougher course, much larger course for that matter, and given the fact there was already a large precedence of a very prominent person from the family who actually established itself there. So people always joke and say that, look, aren't you actually walking in your father's footsteps? They say, I may be walking in his footsteps, but at least I'm not in his shadow.
Yeah.
That's actually the fundamental difference. I charted my own course over that to end up doing it. So CA became a natural sort of succession for that. There was also this sort of little thing in me which says, if this is the hardest exam, let's actually prove your mettle against
challenge which it comes with.
Exactly. So that particular challenge was something. I did actually write my CLAT. I actually did fairly well in CLAT as well. I forgot what rank or something I got during that. But I think during whichever program they have when they do the orientation or something, I was actually traveling during that. And then I just said, look, CA is like the only option. I didn't want to do engineering because Pranav did engineering and he said, God, or don't do engineering. I would prefer to do pure science because I did my computer science all the way to 11th and 12th. But then I realized pure sciences is something you end up doing overseas. You can't end up doing it here. So prefer to actually remain here. Then law was something that ended up actually going away. Then the option boiled down to basically CA or arts. And I said arts is something I don't mind actually doing as an avocational pursuit rather than doing it as my main job. And CA kind of became the default. And then I went through the entire grind, understood that. In fact, for the first exam, I didn't realize you actually had to register in advance and all that. So I missed the June CPT. Actually, I write it in December because I came from science, right? Everyone else in commerce.
You came from science?
I came from science. Until 11th and 12th, actually did science for that matter. In 12th, I was actually spending my lunch break with the accounts teacher just trying to understand accounts. When I wrote my CPT, which is the first exam for CA, accounts is about 60 odd marks. I think I skipped the entire section.
What?
Negative marking, I just said, I can do law, I can do economics, I can do like logic and all that for that, math and all that for that matter. So I actually did that, managed to actually get through. So like, okay, cool. That was the biggest gamble.
Yeah, now they changed a little bit.
Now they changed it a little bit.
Thankfully. Yeah. I think I gave the June 10 attempt. I was able to figure out someone who had my scan code.
Yeah.
We were able to do a little bit. Yeah. But yeah, we'll talk a little bit more about CA because there you have a huge audience base who look at accounting and finance programs. But entrepreneurship, I want to talk a little bit more about that right now. You were 23. How did you know that at 23 you want to start your own fund? Why the venture fund? Because at 23, when we started Zell, again, we didn't know if you want to do this for a long period of time, which is discovering yourself in your early 20s. So how did 314 happen overall?
So Pranav and I have actually been discussing, both of us wanted to work together, obviously.
Yeah.
We realized that's actually fantastic. We've had a great rapport. We haven't had the typical sibling kind of thing or rivalry and all that. We always said it's like us against the world rather than you versus me.
Siege
For that matter.
Yeah.
Yeah. So we've actually had that kind of thing and we said, look, what are the kind of ways we can end up actually working together? I've been discussing that for quite some time. So in the opportunity sets that actually existed there, we could either do a startup the way everyone else did for that matter. But then we realized from a diversification perspective, it's actually putting all your eggs in one basket. If it does well, fantastic. But look at the mortality rates of startups, especially. There are numerous things that can actually go wrong. And even very highly smart, highly motivated, highly talented people have actually seen their first startup or something fail for that matter. They actually go through. Then when we looked at the entire Indian venture landscape as well, we realized something that actually stuck. The average age of the entrepreneur back then was anywhere between about 27, 28 years. I think now it's also in the late 20s, early 30s for that matter. But you look at the entire investing class that's there. Everyone's in their late 40s, early 50s. Some of them are reaching their 60s also. There's a generational gap that actually exists in terms of capital. In terms of thinking between capital as well as execution.
Yeah.
Then we said, look, if the average age of the country is about 24, 25 for that matter, most of these startups are actually catering to people within our age bracket itself. Why do we have the capital class that's actually sitting one generation above that?
Yeah.
Then obviously there's a dislocation. The dislocation that's there. And the second thing we ended up actually seeing is a large amount of thinking, especially back then, was you can't be successful unless you're actually the clone of some sort of US or Chinese company.
Okay.
Everyone's pitch deck I remember when you look at the early pitch decks that came in, everyone just started by saying I am IIT, IIM, etc. There were very few CAs. I think hardly any CAs who came in there for that matter. That was actually one. And the second part, they will come and saying, I am the Uber, I'm the Indian version of this company. I'm the Uber for this, I'm the Flipkart for that, I'm the Walmart of this, and the Amazon of that, and the Google of this, etc. And I said, look, India, one of the theses is one of the beliefs, not just thesis, one of the beliefs we always had is India is not where US was 40 years ago, China was 20 years ago, and all these kind of analogs that people actually do. India took a very unique part to reach where it is as of now. It's going to take a very unique part to end up going forward. What may work in the valley would not actually end up actually working over here. I think that level of thinking is something we're seeing pervading the Indian VC landscape as of now. But no one coming and saying, look, I'm going to be the Indian equivalent of this US company. They say, look, there's an Indian company that's actually doing it. I want to be a better version of that. They realize that the problems that Indian have are actually unique. And given the leapfrog we've had in terms of technology, it is actually a unique aspect to actually end up coming in. And we started looking at those opportunities. We said, look, here's something we can actually end up doing. There's great diversification within the entire base. It's something that we could actually work as operators. Pranav actually did he graduated from RV College, did his master's at Stanford, joined a startup, scaled that to about $150 million in terms of valuation, vested his options, decided to actually come back. So he was someone, because he did his engineering at one of the most prestigious universities in the world, he could actually find companies on the leading edge and figure out, does a tech stack actually make sense, battle test assumptions. And because I did my CA, I could actually make sure they don't bleed too much. So the joke we always have is he finds companies on the leading edge, I ensure they don't bleed too much when it actually comes to that. So we had great diversification within that. And we said these skill sets are actually unique and can be best applied when it comes to this. Because if you understand leverage, and that's the most important part for that matter, the moment you can actually end up finding these companies that no one else actually did. In fact, one of our best companies, Licious, is a company that they went to all the VCs, etc. They looked at that and said, what sort of thesis is this? India is a vegetarian country. You can't build this kind of thing. Everyone wants horizontal commerce. What is vertical commerce? They got laughed out. We looked at that and said, oh, this actually resonates. This is one of those areas, one of those dark horses that can come about and actually build a very, very strong brand for that matter. So that kind of thinking that we had, and we love to find these kind of companies that don't have adjacents across the world and don't exactly receive the kind of love from traditional mainstream VCs the way you actually do. Because that's when you actually start, moment to make these kind of contra bets. And because we're operators, you can end up actually building them. Because entrepreneurs are fantastic. They have a fantastic, great domain expertise. But it takes a lot more to run a business and actually creating a fantastic app. Or actually understanding your market, understanding your customers really well. There are a whole bunch of other opportunity points that actually come in that go into building a business. And these are not things you can end up actually delegating to a third party. These are fundamental to your operations. And you require, exactly. And you require an investor who also understands these. So when we actually work with our companies, we help them through all these areas. We actually build up processes. We make sure that they actually have strong fundamentals there. So whatever DD comes, whether it's M&A, whether they're actually looking for the next round, etc., they have everything that's actually ready, they're battle tested, they can actually sail through. So that's the kind of thinking that we incorporated and inculcated from 314 from day one. And that's actually what held us in very, very good stead.
Awesome.
So when you looked at those kind of sets, we said the convergence of all this. The Indian macros, I'm not going to bore you because everyone already knows that. The data cost came down, this, etc. and everything. But we said, look, from our perspective also, this is a ripe opportunity for us to end up actually raising that. There were too many foreign funds over there, foreign fund managers. So the kind of thinking was influenced by the US. Or there were a lot of Chinese managers or Chinese money started coming, influenced by China. No one's actually thinking about what do Indians like and investing from India. We said that's a fantastic niche for us to get in. And that's how we actually decided to start 314.
So asking for 100 crores when you're 23, 24 years old, that's a tough ask. So how did you go about, I mean, one is thinking about it. The other is obviously executing. You know, everyone's thinking a lot more than executing. And executing is fairly difficult. And asking for 100 crores, it's very difficult. So the magical number was 100 crores. Begin with fund one. How did you guys go about that?
So it was actually tough. So some of the people, so there was some amount of angel investing that we actually saw from the sidelines and all as well. So we understood that. We met other investors, we met other founders, etc. And even when we actually came in, we said, look, we can't be solely providers of capital. If only thesis the company, look, we only give you money and nothing else. We'd rather stay away from that particular deal. So the sort of hands-on operational is something that actually resonated strongly with other people that we invested in. And given the fact that we had this kind of this young energy, we could end up hustling for that matter. When we started off, we actually started the fund with about 50 crores. That's how we actually did that. Then we slowly started building the corpus up also. When people vetted us, what are your portfolio? How are you guys working with them? Spoke to founders, etc. And then we actually slowly clubbed together like a friends and family kind of thing for the 100 crores. It took us a while to raise that 100 crores. In fact, I think when we actually launched our second fund and we started getting a lot more outside interest, that first one was actually still a little open. But we said, look, we're not going to go to external people to get that. Whoever came in initially, we'll ask them, would you like to ramp that particular thing up? And as the portfolio grew, because see, one thing we also realized is they've actually taken our first few backers in fund one.
The biggest amount of risk.
Actually took the highest amount of risk with us. We're completely unproven. We have no VC background for that whatsoever. Whatever we did on Zerodha or Robinhood can't exactly constitute or translate this kind of thing as well. So when he said, look, if there are gains to be made in this particular fund, we rather give the opportunity to the people who actually backed us rather than external people who came in. And because we started getting a lot more external interest, is when we said, look, let's actually launch another fund. So 2016 was the first one. 2017 was the second one. 2018 was the third one. We launched an offshoot called Rising. 2019, we launched an opportunity fund called Continuum. 2020 is when we actually launched Fund 3. So we've done this we've had a unique record of actually raising a fund almost every single year from 2016 all the way to 2022.
So 2016 was fund 1, 100 crores. 2017 was fund number 2. There was 150 crores.
250. So we honestly thought 150. We closed our 150 out in a quarter. Then we started getting more interest. So we decided to actually expand it to 250. And I said 250 is a good fund size at that point in time to end up actually investing. Because the one thing we've been very, very, very careful about is not to actually overcapitalize ourselves. The moment you're overcapitalized, then you start taking all sorts of weird
foolish bets also sometimes.
You start taking foolish bets and you lose discipline. See, the hardest decision in the VC industry is not actually saying yes, it's actually saying no. So the moment you actually have a very high filter for the companies you get in, you have to get very deeply involved with them and have high conviction that these guys can end up actually scaling. You still make mistakes,
of course,
but those mistakes actually end up reducing for that matter. And the more discipline you end up actually getting over here, the easier it actually becomes for you to end up actually scaling that particular portfolio. And it shows. So you have a portfolio which has a strong thesis, a portfolio that actually conforms to areas that you invest in. You don't have like random companies actually coming in. I think the more randomness you actually bring into your portfolio, it's good for diversification, but then in that case, it just becomes like actually throwing darts for that matter. You can't create a portfolio, especially in the early stage, where an early stage is especially important because early stage is not about stock selection. This is the fundamental difference. Early stage is not stock selection, it's actually new asset creation. So with new asset creation, you can't actually create a very varied kind of framework that's there. You need to be a little more concentrated. You need to go far deeper with them. And that's when you actually start generating value.
So fund 1 was 100 crores. Fund 2 is 250 crores. Then came Fund 3.
No, then came Rising.
Okay.
So it was around that point in time where we started actually seeing a number of seed programs get created. And we actually had our investors tell, you know what, this marquee funds created a seed program. These guys are doing seed. Why do you guys even exist?
Yeah.
You guys shouldn't actually be here. You're dead. We've actually had people who actually openly told us that. So we said, look, at that point in time, given the thesis that we have, given the program that we created, 314, let's actually raise a very small fund. In fact, that fund was only 45 crores.
Okay.
We kept that very, very selective.
That was only for seed.
These were completely idea stage bets. That fund is actually done. In fact, we actually had a bet with one of our LPs saying that, would this fund do better, or would an opportunity fund that we did end up doing better? This fund actually did a lot better. And despite
Fund 2 or Flow Opportunity?
No, Rising. Right. Compared to the opportunity one, because opportunity one you enter a lot later. It's still very, very healthy. But on a pure MOIC basis, a multiple basis, this is obviously better because you get him in the valuation, the way I joke it, you get him in the valuation measured in crores, you exit in the valuation measured in billions. So that kind of delta that you create is obviously be far massive. Rather than getting in when it's hundreds of millions and actually exiting when it's actually billions that way.
So then Fund 3 was?
So Fund 3 we decided to actually keep it initially at 100 million. So that's the one we actually in 2020. In 2019, we launched an opportunity fund. We had fantastic companies like Licious, Better Place, Darwinbox, Open, Jupiter were actually coming about. And we said, look, the earlier funds, because only 100 crores and 250 crores, dry powder was actually running out. But we actually had Pro Rata and all these guys. They were just hitting the inflection point at that point in time. And we said, look, rather than getting bullied away, and we've actually seen this happen, a number of seed investors in India especially, they all say, look, I got a 50x, 100x or something. But 50x, 100x on like a 20 lakh investment doesn't actually move the needle, especially for institutional investors.
In terms of total capital, so basically what you're saying is, if I invested 20 lakh rupees and I got a 50x, I'm making, assuming 10 CR. So, but that's not, in terms of total capital, it's not
that high. In terms, it's a fantastic multiple, but it's a multiple on a low base. You need to have a healthy enough base and a healthy enough multiple.
So when it's seed, the risk is much higher.
True.
Yeah, because you don't know. I mean, exactly. From seed to execution also, the plan must have changed a lot. Yeah.
Every company goes to a pivot. They decide to actually wait out on a few things. Some experiments don't work out. But you slowly end up scaling and building the entire thing out. So we launched that opportunity fund in 2019. We have immense Pro Rata on these guys. And we had investors who said, look, these are companies we don't mind investing in because they've been de-risked to a large extent. But rather than coming in by yourselves, you understand management, they know you well, you had a great rapport with them. Why don't you actually manage this and end up scaling that? That's when we launched that opportunity fund. And 2020, when the dry powder, the previous one ended up going, we actually had to do new portfolio construction also then, during the pandemic, mind you. That's when we actually launched our fund. We thought 100 million was a good size. But I think given the fact that interest rates went down to zero, cost of capital was came down to zero over there as well. And most of the other funds, we got immense amount of interest. We said, look, from 100, let's go to our limit, which is 200 million. So we raised 200 million in 2020 for that matter. Invested that. The portfolio has actually done very well. 2020 and 2021, we actually made sure that all our companies got very well capitalized. The simple reason being that we said, look, interest rates have actually gone down and the world is, and the central banks have pumped in such a large amount. Obviously, inflation is going to actually catch up. We said, look, it's not a question of
it's just going to become more expensive.
It's not a question of if, it's a question of when. We said this is a once-in-a-lifetime opportunity. Load up on cash, figure out valuation, etc. is fine, but just make sure you have enough dry powder and capital to continue. So our companies have actually been very well capitalized. In 2022, they didn't have to raise as much. 2023 also, they don't end up
you don't want your founders also to raise a lot of money because it's a big
high dilution. High dilution also. And see, one of the theses we had at 314 has always been that the founders have to make the largest amount of money. We don't want a situation where the founders own like 3-4% of that. We are not investing in these companies for the privilege of running them. I can't run any of these companies for that matter. We are 100% out of that. We know what we're good at. We know what the founders are good at. It's a great synergy that actually comes in. But unless a founder actually has skin in the game, they're not going to stay there. We're actually seeing as of now, so many founders are just saying, look, I've actually it's been a great run, etc. I'm going to bounce. They go start a new company, 100%, raise less money, become more frugal, but they have a larger chunk of their entire pie. So we're seeing that kind of thinking that we ended up actually thinking about way back then, actually becoming the norm as of now. And the thing about early stage investors is not about what's happening currently, it's what's going to happen in the future. And you need to end up actually seeding that kind of thought as of now, building upon that particular thesis, finessing it, such that when it comes to fruition, you're at the right place at the right time with the right investments to actually capitalize upon it.
I was sitting with your dad yesterday, he said, don't raise money. So contrary to what he's doing, he's putting money. So now, I want to speak a little bit more about accounting. How did your accounting base help you actually, because you look at, you said that you're going to stop companies from bleeding too much. That I don't think bleeding too much also makes a lot of sense. So how did the accounting base help?
No, accounting is, Actually, this is one thing I've noticed. This is one of the funniest things we did when we started 314, as we actually went through, even as of now.
Yeah.
Finance professionals are a minority in investing. We found that to be one of the most counterintuitive points to actually exist. But that's actually true. A large amount of this is dominated by people who've done an MBA, people who actually done engineering to a large extent itself. And finance has been tremendous for us because the kind of audits and everything that I actually did during when I was doing my articleship and everything for that matter helped me actually pinpoint to say, look, these are the kind of issues there. So we don't wait for an audit report to actually come.
Yeah.
We speak to the auditor, we actually get copies of their notes, we ask for their own trial balance ourselves. We start vetting those kind of assumptions that are there. Once you actually realize what is the latitude afforded to people to end up making those kind of changes, it becomes easy for you to end up actually catching that. And the moment you can actually catch that for that matter, then there is absolutely no incentive for any founder or anyone to end up actually taking you for a ride. If you notice, as of now, with governance issues actually come about, a large amount has been contingent on the fact that the personal vetting by the fund managers themselves haven't actually occurred. There was relies on third parties. There are multiple other mandates that they end up actually having. And the moment you have a checklist, is the way you write an exam, right? You know a checklist, you reverse engineer the checklist. It's not about what the knowledge base actually requires. So when we understood these kind of things, we internalized that and said, look, let's actually find these kind of issues. Even when it comes to an MIS as well.
So you're basically, because of your auditing experience, you're actually becoming a hound towards understanding what are the red flags.
So we question assumptions. We know that, look, in case your revenue is actually increasing, everyone looks, so there's a joke I have it, there are some investors who, when they read the financials, they look at the top line and actually turn the page. We start from the bottom. We say, look, what is the quality of expenses you're actually incurring? Are these actually validated? If your assumption is I can actually invest so much into this particular product and here's the revenue growth that's there, the assumption fails. You don't end up actually shoveling more money behind that. You end up actually saying, look, here are the failure standards I have. This is when I stop that particular experiment. Let me move on to something else. Let me become a lot more efficient when it comes to that. This battle testing these kind of assumptions is important because a number of people end up getting seduced by an Excel sheet. Life is not run by an Excel sheet. You can't just write 5 numbers, drag it over there, end up actually increasing everything, right? It doesn't work that way at all. Life is not a linear equation. So when we start testing these kind of assumptions that are there and actually holding them to the plan they gave us, and making sure there's actually actual adherence. That kind of discipline ends up actually translating into much better performance by our companies. And this is something, mind you, even when you constructed teams at 314, the other teams who actually look at teams look at growth, teams that look at other operations. But the finance team in particular spends an immense amount of time actually scrutinizing it. It is honestly after a while onerous because so many founders have said, look, I'm an early stage firm, why are you asking for these kind of things? We said, no, we are investing in you with the understanding that you want to build an institution. If you don't want to build an institution, wonderful. There are numerous other investors to go have fun with them. Let's actually find someone else we can end up actually working with. But the moment you're the institutional building, you find out the best practice in the market, inculcate that from day one itself. So the moment we started that and we had this kind of discipline, it's actually held us in very, very good stead. So we don't see suddenly some kind of surprise that someone comes and says, oh my God, I'm running out of cash. We know exactly when our companies need to end up actually raising. It informs our decision to actually invest in them further. We decide whether these kind of pivots have actually made sense or not. We decide whether the market is actually large enough for these guys to end up expanding. Do they have to end up looking at adjacencies over there? Do they really need to hire these many people? I think that's a crucial element that's there because every time America is they're like, I'm going to expand into 4 or 5 other areas. I'm just going to hire like 100 people, dumb over there, let's figure it out. No. The moment discipline actually goes away and that everything ends up crumbling. So that finance background I had, just looking at these kind of boring kind of numbers, and actually drilling down deeper into that. Because behind every number, there's actually a story for that matter. And every line item in MIS actually speaks about, it's the encapsulation of all the operations of that company. It's not the story the person actually says. The story is always, the story is actually great, it's a narrative, but the entire meat of it actually comes from the numbers that are actually present. At the moment you start looking at it from first principles, it's very hard for people to end up actually going wrong.
So now again, another thought is, because you were, it's widely said that grey hair premium exists in the finance industry. Now, we know that it's a more prevalent thing. It's not really a fact. However, when you're confused about if you should be investing, because there'll always be fantastic companies which, again, like you said, I'm going to say no to. I'm going to say no as much as I can because I want to be as sure. But before you start to invest, do you actually go and take advices from people about industry you might not know about, number one? And I mean, and again, when you're talking to the management of the company, you're not controlling the company, like you said. The domain expertise belongs always primarily to the founder and then obviously the investors. So, whose ears do you have?
No, of course. So see, what we end up doing from our side is very simple. It's a very simple process. We never believe we know everything that there is to learn about. They always know we have to learn. We have to learn from people who are smarter than us. And if you're the smartest person in the room, you're actually in the wrong room. You're absolutely in the wrong room. And because we've actually curated our investor base as well.
Yeah.
So even though we got a lot of inbound interest, we always make sure to pick and choose the kind of investors we want to work with.
Okay.
They align with the kind of focus areas we have. They've been operators in the past, or they are operators as of now. So they know the practice of actually building a business as opposed to the theory of it, which is important. So if there's a new area that comes in, we actually vet those kind of assumptions.
Yeah.
Every founder comes in and says, I can become a unicorn in 3 years, 2 years, 1 year.
Unicorn has never been the dream,
Unicorn's never been the dream, but our entire thing is, look, it's not about $1 billion of valuation. Yeah. I can actually put 100 rupees in a company, buy 0.000001 for that matter, and suddenly the guy's a unicorn. It doesn't really make sense. But $1 billion of revenue, that's hard to actually end up getting. So we gone to the guys who've actually got $1 billion of revenue. We ask them, we test those kind of assumptions. We figure, look, is there really a glass ceiling on this market? Can you end up doing? Are there actually companies who are looking to actually enter this kind of space? Is there something in the competition mix we're actually missing? Is there something in the assumptions of the founder we're actually missing as of now? So we prep. We don't actually go and ask them, hey, I'm an investing company. What are your thoughts? We prep, do a homework, go and ask them pointed questions. Yeah. And they love that kind of thing because they get an insight into what's actually happening.
What's new?
Which is very important. And from our side, it's not just that. Even when it comes to matters related to operations, matters related to accounting, matters related to tax, you actually go and speak to the other CFOs of other funds, go speak to people who've actually done it before. And don't go into Big Four. I think everyone, if you in our industry, in the VC industry especially, anything happens just like it's Big Four. It's great. It's important. But look, I actually prefer going to the people the Big Four go to for advice, for that matter. Those are the people who actually have deep, intimate understanding of this and not theoretical. If the law says these kind of things is great. In India, we're notorious for legislative intent, right? Yeah. The Vodafone case was actually a question of legislative intent. What happened with GST and gaming is also a question of legislative intent on that matter. We actually go to these kind of people, understand what is the legislative intent behind these kind of changes that are actually there. And then we take those kind of informed decisions. When crypto was actually hot, when we're raising Fund 3 in 2020, crypto was actually going up to the moon. We took a very calculated call to say, we will not invest in crypto. Yeah. And I got a lot of pushback from the investment team for that matter to say, because they say, look, every other fund's actually doing crypto, all the guys are popping up with their ICO, it's actually great. Why you actually saying no to easy money? Because we've actually been studying the RBI speeches from about 2017, 2018, where they've called it virtual currency, virtual assets. Oh, sorry, they never use the term currency. That's the important part. You call it virtual asset, virtual digital assets, a whole host of other words, and said very clearly, look, we can't, these are not replacing traditional currency. We can't allow it to replace traditional currency for all these kind of reasons. So we knew that India is going to take a very hardline view about crypto for that matter. Yeah. And because we're a 8-10 year product, if something pops in the first 2 years, wonderful. But I still have to harvest it in year 7, year 8, year 9. If it crashes in year 4, everything's actually gone. Yeah. So we actually said no to those kind of things, and it helped because the finance background, legal, you actually read these kind of things, speak to people who understand these kind of parts. It informed our decision to actually stay away from that space. We got a lot of flack from the investment team, a lot of flack from investors. Some investors said, why should I invest in you? This guy has 4-digit IRR, which is unheard of, quite frankly, for that matter. But crypto actually generated that. Yeah. Whereas at that point in time, we got actually 3-digit IRR for that. We said, okay, fine. Don't come. It's completely fine. If you're not aligned with that kind of thinking, wonderful. It's an open market. Find other people who do that. Yeah. Those people, when the crypto crash, when we're actually raising fund for, ran to us and said, you guys understood this, wonderful, can I invest? We said, no, we already have a fairly healthy investor base. We'd rather just go with them. Yeah. Someone actually more aligned to us and our way of thinking. Yeah. So that's the kind of stuff that ends up actually.
I mean, tell me 5 people's names who actually you call when you want some core advice about anything and everything, if it's about work pyramid.
Yeah. So I tell you what. So Padam Kincha is one. Yeah. So Mr. Kincha has actually been fantastic. We've been speaking to him a very long time. And it's actually genuinely informed the way we end up actually operating and thinking about these kind of things. In fact, if he actually says, yes, we can do it, we get a lot of confidence. He says, no, this is a gray area. Question is, can you actually fight it? Is it worth fighting for? If he says, yes, we end up pursuing. He says, no, we say, look, let's find something else that ends up actually working with. I'm speaking from my perspective. Yeah, of course. So Pranav and others have his own set of people he speaks to. I end up actually speaking to a different set of people and all that. The next is a person called Mr. Ravi Shankar, who's actually when it comes to GST and the like. So that actually informs the way from the VAT service tax regime all the way to now. Just understand how these kind of changes have happened. Understand in the business model that the company has as of now, even though they say it's new, it's innovative, it's this, is that. Every business model as of today is actually a traditional one with a layer of technology. It's put on top. So don't get seduced by the technology part that's actually there. I've seen numerous fintech companies say, I'm not a fintech company, I'm not a finance company, I'm a tech company who has some elements of finance. Whereas RBI has very clearly said, doesn't matter if you're a Pani Puri fellow, if you're dealing in finance, you have to get regulated. Yeah. It's straight up out of the fact, right? Yeah. And that thinking is actually becoming pervasive as of now. So he's someone I actually end up going to actually get that kind of exam, kind of advice. Then there's Rajiv Saptishi of the Kotak Asset Advisors, as well as Saurabh Jain from NIF. They're the CFOs of both those places. So anything related to AI of operations, what ends up happening? Is there something you can actually end up pursuing? How can you end up actually betting that? The three of us often end up speaking, meeting. In fact, I actually created something along with them as well as a few others. We actually created something with the Private Equity Venture Capital CFO Association. We said, look, given the fact this is a brand new asset class, there are no parallels for this asset class in any other part of India's entire operating history. Mutual funds are not the same as AIFs. AIFs are not the same as VCFs in the past, etc. We actually need to create a forum where all the finance professionals, CFOs can actually get together, discuss these kind of issues, because it's not a question of right or wrong. It's a question, finance has never been about right or wrong. It's not this kind of moral arguments are there. It's, are you consistent or inconsistent? If everyone's actually consistent with the right kind of idea that's actually there, then it slowly becomes industry practice. And so long as the industry practice doesn't actually prejudice public good, or doesn't go against any of the regulations that's there, it slowly evolves and actually ends up actually getting enshrined as part of that. So we thought it's important for us to actually create this kind of forum to end up actually getting that part too. So depending on what other things end up happening, we end up actually reaching out to various people. But these are the kind of people that are always on speed dial. You just call them, they give you an answer. The beauty is, you ask them a question, it's not, I'll get back to you later. It's, you ask your question, here's an answer. If I have to do research, wait, I'll get back to you by a defined time, but there's always an answer that comes. It's never this sort of one line which says, okay, it's possible for you to do so, and 20 pages of disclaimers that you have to wade through on that. That kind of clarity, especially in this nebulous industry, makes a world of difference.
Awesome. And let's talk a little bit about failure, because we touched upon it earlier. How are you dealing with failure? Because when you're investing, things can go wrong after you put money in. I'm sure there might be a few cases. How difficult is it to bear? Because the brunt of actually borrowing money is also very difficult. And you want to perform, you want to outperform.
True.
I think two of your funds are almost towards now the closing stages. But how are you dealing with failure, and what kind of failures are you dealing with?
So the biggest failure that ends up happening here is the company actually shutting down, or your paper gains not being translated to reality. I think that's actually a core element of what is actually there. Thankfully, because when the early stage failure is expected, we actually have amongst the smallest, lowest loss ratios across the entire industry, because we have a very calibrated discipline program, and we want to actually go much deeper with them. So if something actually goes wrong, we work immensely hard to make sure that we can extract whatever value we actually can.
Because
not just for us,
but you're not in control of the company.
We're not. But
so that's why
the alignment of
irritating.
No, but the alignment of interest exists. See, this is why I love working with our founders, because none of our founders have ever come and said,
don't interfere.
No. It's not a question of interfering. See, with all our founders, we never go there and we actually pull rank. Say, I'm your investor, do this. We go there and say, look, this is our thesis. What do you guys think? We battle test that. There have been numerous times we've actually been wrong. The entrepreneur's proven us right. Numerous times where we've been right and the entrepreneur believes, yes, I should have actually listened to him. For that matter. But we maintain the kind of dialogue, and it's always healthy. See, the moment you end up becoming the kind of imperious investor who says, do this because I'm so-and-so, I have 30 years experience, I've done this, I've done that, etc., then you lose a battle. And the moment you lose respect in a transaction, that goes. And that's why I said the age difference is there. For a number of founders, it's actually going back to where they were when they were in school. So suddenly, like a school teacher, the investor, like a school teacher, actually abusing them for doing all sorts of stupid things and all that. But you go to them as a peer. You go to them with logic. You go to them with substance. You go to them with data. It's very hard for them to actually end up saying no. So even though you're not in control, you don't have to be in control of the company. So long as you can actually speak to them and have a conversation, and there's mutual respect between both, they always end up actually seeing the light of day. We've been wrong, they've been wrong. It's not a question of who's right. It's a question of what's actually best for the company. So that alignment of interests allows us to actually generate the kind of value that we end up actually seeing. So our biggest thing is that I remember one of the first companies we ended up actually writing off was a company called Truce. Saurabh Jain, who's now the founder of Stable Money, fantastic founder over that. He actually looked at that entire model and said, look, the thesis I actually had versus once I put into practice what I ended up doing as I realized, look, I'm not making the kind of change that I actually want. So I said, rather than actually going down this entire game and not generate kind of value, I'd rather actually shut shop now, close it off, return money back to investors. So it's kind of shocking. We were, I think this is the early stage of 314 also, we're actually raising a fund and said, we're suddenly having a loss where the guy actually says, it's not because he ran out of cash. He has cash in the bank. He said, look, the thesis I had versus what I can achieve, there's a divergence between them. I'm not comfortable with that. I want to put it up. So during that time, we were trying to figure out why. But over time, we realized that's actually a very mature decision. All of investing ultimately is you have a particular thesis, a clash of reality. There are times it works.
Of course,
Like Licious, etc. It worked. It became 10,000 odd crores. It's actually going to become far larger and everything soon. But compared to that, there are companies who end up and we learn a lot more from these companies who say no. And that as a companies who actually end up failing. Because they say, look, these are the kind of assumptions. This is what the market actually accepts. And the market is above all of us for that matter. And so that actually informed the thinking and the thesis we end up having. So we thankfully haven't had the major kind of dislocations that people have actually heard of. So far, touch wood, and hopefully that doesn't end up happening. But we managed to all our learning end up actually just controlling that to the largest extent possible. We will have portfolio failures. We'll have companies that get written off. That ends up actually continuing. We'll have sales and we will not get back principal. But that's all part of the entire process that's actually there. And we just want to remain as cautious as possible to make sure we minimize that risk.
Yeah.
And that risk minimization actually takes constant effort, constant monitoring, and constant oversight. The moment you take your eyes off the ball,
everything actually goes. So you're always paranoid about...
You're always paranoid.
Yeah.
Only the paranoid survive. Right?
Yeah.
That's always there.
So you're also the ESG officer, yeah?
Yeah.
So so we're launching an ESG program, right?
Very nice.
I think probably one of the first programs in the country to work on finance professionals.
Nice.
Can you talk a little, just in 30 seconds, explain what is ESG?
So ESG is one of those really loaded, abstract terms that one actually puts. Well, look, the purpose of ESG is to actually become a more responsible citizen, a more responsible investor, more responsible operator. You look to break it down. The environmental part, everyone's actually concerned for that matter. And the environment is actually greatest strategy or commons. If you look at the accounting for the cost of actually producing a product, no one actually accounts for the effluence they end up creating, the kind of negative consequences of the market.
Yeah.
So accounting for that becomes an important piece, and it's something an accountant ends up actually implementing. So the environment part actually goes. The social part obviously is a factor of actually treating people well. You can't end up actually abusing or exploiting people. You can't end up being discriminatory in your practices. It's simple for you to end up actually putting that kind of thing. Make sure that whatever you end up doing, you take a step back and understand the wider societal impact what you end up doing. This also fed our investment thesis, where we said there are certain business models which are highly lucrative.
Yeah.
Can end up generating
like what? I mean,
I'll give you, this is, okay, there's not a company we ever saw, there's not a company we'll ever see or even do work. If you look at OnlyFans for that matter, it's the worst example possible.
Yeah.
OnlyFans, by the way, is actually saying we're ESG compliant now because we actually help gig workers achieve sources of income. It's one of those ways you end up twisting ESG to suit your kind of purpose. But OnlyFans is actually generating amongst the highest pools of profit that are available. But there are obviously deep social issues that are actually inherent in that kind of business model. It's not a moral argument. It's not actually pushing some of these people over there, how it's actually getting exploited. So that kind of elements we end up by saying. We look at real money gaming and these kind of things. We say, look, it's a game of scale, it's a game of chance, it's a game of this, it's a game of that, etc. But there is a chance for it for some of this to end up actually going wrong. So we prefer to end up actually staving it. Look at alcoholic beverages and the like itself. You can end up making a lot of money in booze. Yeah. We've actually taken a call to say, no, we rather not end up actually going under that particular piece. So we may end up being customers for some of these companies, but we will not only fans, leave that aside. So don't make that kind of coordination. I'm just calling that out, obviously. But we may end up becoming customers of some of these companies, but we won't exactly become investors in these as well. So we have a negative list that we've had, and it's held out a good side. We said, look, we understand what we're good at.
Yeah.
We don't have to be the best investor in everything we end up doing. Yeah. We have a domain, we go well. And governance is a lot like personal hygiene. Yeah. If you do it well, no one realizes. If you do it badly, nothing can hide that stink. Yeah. So we look at ESG and we said, look, my role as a CFO also for that matter is to actually make sure that the firms are on the straight and narrow. That portfolio companies actually adhere to law, that our books of accounts end up actually reflecting the true operation of the company, whatever assumptions that are there's nothing that's actually being hidden. You actually become transparent. So you look at ESG is something that ends up actually coming in. And I firmly believe ESG is something that finance professionals can end up actually dominating because the work that you end up actually doing that is about measurement. Yeah. It's about calculation, it's about measurement, it's about assessing whether something's viable or not. Yeah. It's about translating that into factors that people can actually end up understanding. And the oversight function of finance professional gives them deeper insights to these kind of things. I don't believe it's a vertical function the way people are making out to be. ESG ends up becoming a horizontal across the entire industry, and the one who always spans the entire part will always be the accountant for that. Yeah.
So, I mean, the ESG score, which is, been in news for the last 18 months, especially when Elon Musk said, listen, this is a farce. Yeah. Because tobacco companies and Exxon, which is into petrochemicals, petroleum overall, they have fantastic ESG score, and Tesla has not been given the best ESG score. So from what I understand, help me if I'm wrong, ESG score basically talks about the inputs which you're putting in your company and how hazardous is it to the environment, socially and in a governance state of matters. But Elon's rebuttal is, look, I'm one of the persons who's trying to save the world. Yeah. I'm making cars which are much more sustainable, which are less, if not zero, but they're less polluting. Yeah. But still, he has one of the worst, in Tesla has one of the worst ESG scores. Is that what the ESG score is encapsulated?
It's not.
So tobacco companies have a very good ESG score. Yeah.
See, that's the thing. Even I said, even OnlyFans has become an ESG company. Right? Yeah. So see, here's the thing. That's why I said it's a very loaded, abstract term. It's something that's very malleable to whatever you want. Yeah. Even look at the ESG score that came in for those indices. Yeah. It's a fund manager deciding what they wanted. And those fund managers said, look, we know there are companies who are actually not ESG compliant as of now. But so long as management has articulated a plan or a desire to become ESG adherent in the future, we believe we should actually use money to support these kind of people because the day we choose to exit the company is a signal to the entire market that this person not actually meeting his particular plan. So that's the thing we've watched. So ESG is not, that's one element of the ESG score for one particular firm. They go a number of other firms who come out and said, ESG score, wonderful, EV is there, Tesla is the best, I'd rather get Tesla to actually come into it. So the way you define ESG, the way you implement ESG and the way you're actually clear about that actually makes a fundamental world of difference. But you should not end up weaponizing ESG to end up actually force-fitting that into whatever you want. Then you can actually take arms companies. There are people that, I've actually people joke and say arms companies are actually ESG compliant because they're actually helping reduce the carbon footprint of the world by actually taking care of population. You can actually twist anything you want to actually suit the kind of narrative that
it's like defense companies saying that we're
exactly.
Like Robert Downey Jr. coming in and saying, I'm helping in world peace.
The moment I have the biggest stick, no one is going to try to no one's going to try to attack us. But see, that's the thing. It's very important for an investor, even a shareholder, to be cognizant of these kind of things, ask these kind of questions, and then to actually take a call on those matters. So ESG is something that, given how broad it actually is, you can end up actually, it becomes a broad enough tent for anything to end up actually coming under. But I think so long as you're clearly defined in what your practice actually is, you understand what you can do. And you can call out BS when people are actually doing that. I think these are fantastic skills for someone to end up inculcating, end up actually kind of. Whether you call it ESG, I'm fairly certain in 4, 5 years or 10 years down the line, they'll rebrand it to something else. But don't look at the marketing term. Look at the core principles that I actually spoke about. So long as you follow those kind of things, they can call it whatever you want. If you follow that, then it's something you end up assigned to you and scaling.
I mean, this is a question you might not want to answer. We can edit it off also. But Licious is also an organization which is basically in meat. So environmentally, are they also,
so this is the thing. Now, ask yourself a question. Meat eating exists amongst a large section of the global population as well.
Not that. Then I'm saying that how do you raise the animals? That's always the concern.
That's there, which is why Licious actually spent tremendous amount of time to make sure that the entire transaction chain that they have, they are actually being socially responsible throughout it. So they're not going to have battery kind of farms and end up actually going there for that matter. And if you notice, meat is something that the taste, especially if it's fresh for that matter, it's not frozen or something. The taste profile is something you can actually easily differentiate between something that's actually been raised in those kind of really horrible conditions versus something that's more free range for that matter. And what Licious has actually done is supply chain as well. And we've actually spent time with them. The founders have taken that, they've run it, they run with that, they've actually scaled that up around to say, in order for them not to compromise on the taste, they have to make sure that the entire transaction chain actually takes a more humane approach to the particular animals that are actually coming about. So don't raise them in a battery farm or something for that matter. Make sure they're actually given proper feed. Make sure they're actually taken care of properly. Make sure even the slaughter and everything, which is more or less controlled by the government, actually happens in a very, very humane way as well. Don't see those kind of really visceral pictures that people end up putting there. It's not something that Licious actually espouses on his entire path. So see, if you look at it, even from a need perspective also, the need to actually have meat does exist. And Licious already created plant protein as of now. And Licious is very certain of one thing, we're a protein company. If the entire profile of the people ends up actually changing away from animal protein to plant protein, and that actually becomes the norm, Licious already has products, and Licious is going deeper into that entire phase as of now. So it's not a question, it's a question of actually fulfilling a basic need. If you look at the person's diet, protein is exceptionally important. A large number of the health issues that Indians have is primarily because of high degree of carbs and processed foods actually coming in. The access to quality protein is something that's actually needed. And access to quality protein that's actually been reared in a humane manner actually does make an important difference on that. So that's what the thesis that actually came in behind Licious also. So, I mean, you don't have to edit it. It's a fairly open thing that's actually there. But these are the kind of questions you should actually ask. Question our assumptions, point the kind of thing out, and there's always an explanation for it. And we're highly transparent about these kind of things.
Awesome. Two of the companies you've invested in, you've actually enjoyed investing in that. The companies overperformed or whatever, given you a good bet, or two of the companies which you're super excited about. Primarily D2C brands.
So one company is Licious, because obviously what they've actually managed to create at a point in time where the fundamental thesis was India, there's no protein brand that's ever going to come out of India for that matter. So there's the amount of stuff they had, and the founders are fairly open. They've actually called VCs vegetarian capitalists and all sorts of terms and all that rather publicly. But I think what they actually went through was actually truly traumatizing. They said protein as a space can't actually end up existing when it actually comes to that. Premium as a space, why would India actually pay? The per capita income so small. There's only so much. I see. That's the thing about that's just taking a sidebar as of now. The Indian TAM understanding is actually so massive. They look at 1.4 billion people and they assume it's uniformity around. In India, you can actually go 100 kilometers, cuisine changes, culture changes, approaches changes. Everything actually ends up changing over there. We're not, even though where unify the entire country, there's a large amount of diversity that exists. And that striation of your total addressable market also is there. There are 100 million people in India who are actually living lives comparable to what the elite in the US or the West end up actually living. And 100 million people is 1/3 of the US's entire population. That's an exceptionally large amount that's actually there. So premium
in an underdeveloping
in a developing country where this sort of disposable income is only going to end up increasing. It's only going to become far richer.
So the hope is that India grows from 100 million as a TAM, which is the target market, to 200 million. That's what we're all hoping for.
That's what everyone's hoping for. That's what everyone actually.
And don't track for that.
So that's when they started as well. They never said we are 1.4 billion people and all that. They said no. Look, this is the proportion of population that anyone ends up eating meat. These are the kind of things they end up actually eating. These are our products. This is where the premium market actually exists. It's a fairly large premium market, and the premium market is actually growing faster than the rest of it itself. And it's also highly elastic. Also, once you've actually tasted something like that, if it's something that's part of your daily diet or daily operations, it becomes very sticky and very, very elastic from a consumption perspective. So it takes very large dislocations in terms of price in order for people to end up actually changing behavior, which is one of the fundamental learnings we actually got from that. So in those kind of situations, when we actually seen that kind of company, where there were two guys on a laptop, this barely incorporated company, I think did about 20 or 30 or 40 deliveries or something. For a very new fund that we had just gotten a SEBI license, just trying to figure all that out as well, to make that kind of investment. And we invested them in almost every single round that they've actually done after that. In fact, more often than not, they would often come down, we discuss the plan, we'd be the first to actually commit. We may not be the largest fund in any of those rounds. It took us quite some time to reach the scale we have as of now. But we firmly believe, and they've often told us, that they're the ones that end up valuing the most, because once someone actually puts their first check, then the round actually ends up getting created around that. There's a lot more confidence that actually ends up coming there. Similarly, there's a company called Cuckoo.fm also, who recently raised from IFC.
Oh, it's called?
Cuckoo.fm.
Okay.
KU. So they raised recently from IFC, raised from Fundamentum. We were also done this company from very early on. Once again, fantastic founders. They've actually built out a great thing. It's an audio podcasting platform. Where people looked at it and said, it's audio podcasting. You know what? And audio in India only means Saregama, means Ghana, means music. Why would people actually listen to this? Spotify can't even crack into India. YouTube is already killing it. Why are you guys going to do that? You don't understand this. Why would people pay? You're doing it in Indian languages. Why would people over there do it? So all sort of biases end up actually coming over there. But we were firmly convinced, look, Indians do actually pay. This notion that Indians don't pay is one of the most baffling notions I've ever actually thought. A large majority of our GDP is actually driven by consumption, unlike China, for that matter. If people aren't actually consuming, our GDP wouldn't be as large as it actually is. There's obviously consumption, but Indians are value conscious. So just because you have a slick-looking interface, but your offering is isn't actually great, why would they actually pay for you? Or just because you have great investors, they're not going to look at the investor, look at the pedigree of the founder and say, yes, I'm actually going to give you money. They look at value. So the moment you understand the kind of value and you can actually serve the kind of value, it does. So Cuckoo.fm, we've actually been with them. They've also gotten... It took quite some time for people to actually end up actually looking at that. They said there are much larger people who are already there. How can you guys actually get into it? We stuck with them, invested in every single round, helped scale that up, evangelize the thesis, spoke to people about it, had them actually figure out their operation, had them actually finesse that entire piece. And there were changes in regulation that happened during that point in time. The company had to pivot, the company had to go a lot deeper into certain areas, etc. We did all of that, and our company has become one of the largest in the entire space. In fact, the company has 80% of the subscribers that Netflix has as of now, from tier 2, tier 3 cities. Netflix has about 4 million subscribers. In India. It's an Indian company where people paying in rupees. In fact, the first digital transaction for a number of their customers is actually that. If you actually walk down, if you look at a security guard or someone, and they actually have a earphone in a piece, more often than not actually listening to Cuckoo. They're not actually hearing YouTube, anything else. They're actually on Cuckoo, and everyone thinks Cuckoo is actually for fictional books and not. That's actually not true. Cuckoo actually self-help books, how to learn English, find a personal finance and all, actually sells a lot on that particular platform itself. It shows that Indians want to learn. Indians are not just generous with their time because they just go on something and spam whatever, Binod or something on YouTube and all that kind of crazy stuff that people assume Indians actually do. Because we're so large, the small number of people end up actually doing this, people extrapolate that to be the entire country. So that's the lack of understanding about India itself.
For any industry, I mean, when we were talking to venture caps, we always said that, you know what, there's so many things you're trying to basically cover yourself with, you're trying to de-risk yourself. But there's always been 1 or 2 people who screwed up for the majority of the 10 people.
True.
And that is the reason why, I mean, you do it in 314 itself, but I mean, there's always 1 or 2 people who screwed up for the majority of the population,
Is that, so see, that's the thing, right? You need to be able to discern the signal from the noise. People, the moment you end up reading it in media, it's like, oh, this is the entire industry, this is this. It doesn't work that way. there's a lot more innovation that's actually happening. Just because the person wants to do it silently doesn't mean it's not actually going on over there for that matter. Having the kind of insight and actually going and finding these kind of people out for the same and helping them actually build this kind of business, something that's the reason why we actually get up every morning.
Awesome, man. Awesome. And how does the next 12 months look like for you? Are you raising any more funds right now?
No, we managed to close out a fund within 1 quarter. We're actually very happy. We're silently investing. We're going about that entire piece. But I think what we want to do in the future, if you actually look at our future plans, not just the next 12 months, because there's a lot more we need to end up actually doing. We don't want to be the first fund in the country, first homegrown fund to actually raise $1 billion. We could have actually raised $1 billion right now. Which is there.
If you need $1 billion, you can raise $1 billion.
We can raise $1 billion. I mean, with a little bit of stretch and effort, etc. We never use a distributor ever. We've always made it. Even inbound interest, we actually spend a lot of time speaking to the investors, understanding them a lot better, seeing whether they actually fit our kind of thesis before we end up actually taking them on board as well. That's why you said no to a large amount of money that we've actually raised. So it's not about raising $1 billion, which is there. We want to be the first one in the country with a small base to end up actually returning $1 billion or more. The biggest problem in India has traditionally been in this asset class via the returns, via your distributions. And every single time I've actually, when we were fundraising, the people who said, I've invested in the VC fund in 2004, the guy couldn't give me my money back. I said, sir, in 2004, I was in school. What on earth, why on earth am I actually paying the price for something that happened before I even knew what VC actually was for the same? So that kind of thing. India's actually changed from 2004 to 2024. India's actually gone through tremendous kind of change for that. And for you to be blind to that because you had one bad experience 22 decades ago, it's actually doing a disservice to the entire industry. So we'll be the first one to end up actually returning $1 billion when it actually comes to that. We also want to build an institution. Right about now, when people look at the firm for that matter, we want to make sure the team also has the level of competency across every single person, from the partner all the way to the analyst, is actually commensurate and actually similar. So even if something happens for that matter, you can actually end up going. Because see, early stage investing, like we said, we could do early stage investing because we were younger. But as we grow older for that matter, it's going to become harder for us to maintain the kind of agility in the early stage. On the early stage is exceptionally taxing on every single individual. And if you're far older, it generally becomes harder for you to end up actually putting in that kind of effort. So we want to actually build that kind of institutional framework. So no matter who the partners are at that point in time, no matter if something actually happens, etc., we always have people who end up actually encompassing and imbibing the ethos of 314, the kind of program that we have, the discipline that we have, the way we end up actually executing, and create the kind of homegrown institution. We don't have homegrown institutional investors as of now. We've had some of them who've been there, but no one's actually gone through an entire cycle. It's not about 10 years or the 5 to 10 year journey. It's about 30, 40, 50, 60 years. It's something that has to outlive you. That is something we end up actually aspiring to and end up working towards every single day.
Awesome, Siddharth. This was really fun. I think we'll do this again for sure. Thank you so much for your time, man.
Thanks so much.
Bye-bye.